we've been talking about the micros, but let's talk about the macros now. Tushar Poddar, the chief India economist at Goldman Sachs, joins us now to talk about that. Hi Tushar, good evening. You predict a 7.5% growth this year and 7.9% growth next year. Can we grow faster when the global growth appears to be slowing even more?
It would. I think the external drag continues in 2016 because we're not seeing a sharp upturn in the global economy, but domestic demand in India has turned. If you look at urban consumption demand, for instance, it's clearly showing an uptick now. And a whole host of indicators are suggesting that the cyclical activity is picking up. You've got 125 basis points of rate cuts which have been delivered, which are going to pass through the system gradually. You've got a fiscal expansion that's going on with government spending coming through. And you've got the urban consumer finally showing signs of life. So I think this cyclical upturn, which is based on domestic demand, can continue in 2016. So you will see an improvement in growth as you go through the year.
Okay, let me persist with the growth theme. Next year, public spending by the government may fall because the government has to fork out money for the 7th pay commission, plus bring down the deficit by 0.4% to 3.5%, something that they will cut the public investments. Also, the private sector is still going at 70% capacity utilization. So where do you see growth coming from?
I don't think that public capex is not going to continue. I think we've already seen a sharp increase in public capex. If you look at the spending plans for highways and railways, it seems like a pretty ambitious spending plan, and it's not only for 2016 but also medium term. So I think that aspect is foolproof. I can't see the government cutting back on the capex plans which have been announced on that regard. And as you said, you know, the pay commission recommendations will add a stimulus to domestic demand and private consumption as well. There is an issue about managing this to contain the fiscal deficit. That is going to be a challenge. There are some helpful aspects, which is the increase in excise revenues on the oil front. But also, I think the government would have to find sources of revenue and do greater disinvestment in FY17 if it has to continue to spend both on capex as well as on the planning commission. Even that being said, I think the sharp fiscal consolidation path that the government has outlined is difficult to achieve for FY17. I think that they will have to be slightly less ambitious. And I think what they will try to do is to come on the side of capex more than on the type of fiscal consolidation that they have outlined. So it's not going to come at the cost of growth, I don't think.
Okay, Tushar, the RBI's Jan to March 2017 forecast is indicating there isn't much room to cut rates. So how much do you think the RBI will cut? And more importantly, how much will the money get cheaper for the borrowers, considering that banks have not passed on yet?
So I don't think RBI rates are going to fall. I think that the RBI is probably done with rate cuts. If you think, you know, we are expecting 125 basis points in hikes by the Fed between now and the end of 2016. The risks to inflation are all to the upside. You know, whether you think about the pay commission impact, whether you think about adverse weather conditions through El Nino, the fact that we've had 2 bad monsoons, so groundwater is depleted. There's still structural bottlenecks in the food economy. All the risks to inflation are to the upside. I don't see downside risks to inflation at all. So if the RBI is pat, then what happens to lending rates? I think that there is still monetary transmission has not happened to the extent the governor mentioned that only 60 basis points has transmitted of the 125 basis points. So, you know, I think that is going to happen, whether voluntarily or through moral suasion by RBI or through the advent of a new way to calculate the base lending rate. I think that there will be greater monetary transmission, which means that lending rates will come off. However, the RBI, I don't think, may have too much room to cut further.
Okay, so the RBI won't have room to cut further, but finally, how do your global colleagues see crude next year? More lows expected, and more importantly, more lows on metals as well?
So our view is that the structural view is lower for longer. And the near-term risks to oil especially is significantly to the downside. Inventories are at record levels. So you could see significant downside risk to oil prices in the near term. However, as you go towards the second half of 2016, we see a pickup in oil prices, partly because of a waning away of some of this inventory, demand pickup, and also because some of the base effects go away. So we see oil, our 12-month forecast on oil is 54, but the metal forecast, and it's very important to sort of distinguish between oil and metals, is for much weaker metal prices. Copper, iron ore, thermal coal, all of these will decline quite considerably.
Okay, that's not a good thing as far as global demand is concerned. That is the key barometer of global demand. But I guess for oil importing nations like ours, we can't expect more. But thanks so much, Tushar, for joining us and giving us your view. Let's take a break.